Hello and welcome back to the Complete Day Trading course by Wealthy Education. In this video, I'm taking a look at order trading types. So I mentioned earlier there was a paper trading account on TradingView that you can use to place orders, but there are a certain handful of orders that you use on a daily basis. So in this video, we'll take a look at them and why you may use them and why you may not. So you can right click on the chart and go to create new order. And there's a market order comes up. Now, the market's closed, so the gap shouldn't be $5.31 on Apple, but it is because, the markets are closed. We don't actually have any trading going on. But a market order would be simply buy or sell. So I want to sell, I want to buy. So say I wanted to buy Apple. A market order would put me in the market at the best available price for however many shares I'm willing to buy. Go down to the quantity. You can set your stop loss and your take profit right away. And just put in and say, I want to buy it right here at this price or the best price available. And it will fill me at the best price. It might be $219.31. It might be $219.30, $219.29, $219.33, whatever. It'll be somewhere in that range. Typically the spread isn't like this, as I'm sure you're aware of. But that is the easiest way. A market is just simply get me in the market at the best price available. The problem, of course, is you do get some slippage, so it's not the preferable way to enter. So there are limit orders as well, and a buy limit order, which would be buying at a price, limit, goes underneath the current price. So let's say that I'm willing to buy this stock, but I'm only willing to buy it at $216. And again, this is a very wide spread. It's not typical. So what happens is that it puts it out there. And if somebody's willing to sell my 100 shares to me at 216, my order will get filled. And then we're off to the races. You can also use this as a way to get out of a profitable short trade. Underneath the ask. So say you were short from 220 or 250 or whatever. If somebody's willing to pay you 216, you're willing to get rid of the trade. Now, the problem with limit orders is if your particular price does not get hit, if there's nobody willing to in this case, sell to you, it'll just skip right past you. It says, I'm only willing to pay this amount. Now, a sell limit order is the exact same thing, but an opposite. So it's above the current bid. So in this case, I want to sell at 216. Right now, they're only bidding at 214, so they need to drive price up to me, and I will sell them 100 shares. It's also a way to perhaps take profit on the way up. But if it blows past 216, it might be 216 and a quarter before you realize that, and in this case, you make more profit. That's not a bad thing, but it's just to let you know that your order may or may not get filled. But it is a way to get out at that specific price. So that is a sell limit order. Now, there's also the buy stop order. So a buy stop just means that it's a bid that's placed above the current price. So I'll just do 220. And it's only filled at or above that price. Now, why would you want to buy, say, at 220, just say you get some slippage, it's 5 cents. Well, the reason is that perhaps you are short and you are looking to protect profits or just protect against major losses. So once it hits this price, it'll get you out of the market at the best available price. Now, it may slip a point or two. You just don't know. But it's a way of protecting your account, if you would. It's basically a stop loss on short position is a good way to think of that. And it is a market order. So again, it doesn't guarantee you'll get filled that price. But if you were to do a buy limit order instead, if it skips your price you're still in the market. And that could be a lot of trouble. If it's a fast moving market, it skips the nickel and it goes straight to 6. You could be up at 225 and still short this position. So that's why you want to use a stop as a way to protect your account. The last thing you wanted is to have it pile up on you. Now, there's also the sell stop order, as you can imagine. And it is the same thing. If you're long of the market and you want to protect, say at $200, you want to get out, it's a market order to protect your long position. Doesn't mean you'll get out at 200. You might get out at 199.99. Typically with a liquid stock like Apple in this case, you typically get your fill price or maybe off by a penny, but it's just simply a way to protect yourself from getting into major trouble. These are mandatory. You absolutely must use these types of stop loss orders, because if you don't, you can get hurt. Now, a stop loss here, like if you just go in with, just say the market, the stop loss acts as a stop order. So does the take profit. If you wonder what those are the same thing. So those are stop orders. Limit orders, the easiest way to remember this is market orders is get me into the market. It doesn't matter to me, however. Limits are I'm willing to pay or sell at this exact price only or better. And a stop loss or stop orders are stop losses. So essentially this is if price reaches this level, I want out as quickly as possible.